Hi, guys. Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is Managing Editor of Commercial Real Estate Direct, Orest Mandzy. Now, Orest has been at the forefront of reporting financial news and information for over 3 decades now, and for more than 20 of those years, he's been leading the charge at Commercial Real Estate Direct, the leading resource for the commercial real estate investment space. And so with that, guys, it's my honor to welcome my guest for today's show, Orest Mandzy. Orest, how you doing today, my friend?
I am well, Kevin. How are you?
I'm doing fantastic. Excited to have you here. As I'd mentioned, I've been a subscriber to Commercial Real Estate Direct for many years now, definitely 5+ years. Just a ton of great information that you produce on literally a daily basis. Just lots of great things there. So surely suggest to everyone that's listening to this show to go subscribe. They've got a free option for subscription, and probably more than enough to keep you busy for quite some time every day as you get the updates. Orest, moving on here to the show, and what I love to do and what I like to do most of the beginnings of the show is, I gave you such a brief introduction. It surely doesn't give enough credit for your background, how you found your way into the space. So again, I'm going to pass it back to you if I could, and kindly ask that you give our listeners a little bit more of a background of who you are, and then ultimately how you found your way into the commercial real estate world.
Sure, I appreciate it. Thanks so much for the opportunity to speak with you today. It's a pleasure, and I'm humbled. But so I got into the commercial real estate space, or covering the commercial real estate space, almost by accident. I've been a reporter all my life, all my professional life. Out of college, I worked for the American Banker, and then I moved down to a couple other things. During the S&L bailout, this goes back quite some time, in 89, a couple of colleagues of mine who were at the American Banker had started something called, back then it was called Thrift Liquidation Alert. It was a publication that tracked the bailout of the S&Ls at the time. And you probably know this really well, that the S&Ls kind of tanked because they were extending long-term loans on commercial property using short-term funds, short-term deposits. So they went belly up, and we were tracking that. And that's kind of how I got into the commercial real estate market. And I've been tracking it since then. So that's, going on 30 years now, if not 32 years. And I left back then. We converted that publication to Real Estate Alert, and 22 years ago, we launched what now is Commercial Real Estate Direct. It was funded with venture capital. I didn't put capital into it initially. After the .com bubble burst, I was able to acquire it. I put some money together and bought it for myself, and operated it independently up until about 7 years ago, when one of our customers, Trep Inc., they were a very active user of it. They were a big data analytics company tracking the CRE space, the commercial real estate space. They used us for a lot of their sort of the color on the data. And said they decided to acquire us, and we've kind of been melded into their product, into their key analytics product. And here we are today, covering commercial real estate and the CMBS market every day.
Yeah, fantastic. I appreciate that, and I definitely want to take a dive into your venture into entrepreneurism. But before we go there, I want to cover a little bit more of Commercial Real Estate Direct, and ultimately, for the listeners that aren't familiar with that platform, just give us a little oversight as to what they might expect. What type of resources that they can ultimately access via that platform.
Sure. All right. So we're run by. Our staff is basically a bunch of journalists. So we're out getting news and information on the commercial real estate market, and we're cognizant of who our subscribers are. They're investors, lenders, property owners, what have you. So we're trying to give them intelligence on the market that they could use, that's actionable. I mean, it seems like a cliche type of term, but if an owner of a property in, call it Houston, an office property in Houston, understands what properties surrounding his property are selling for, it gives him a better idea of what the value of his property is. And if we'll report that lenders are I don't want to call it redlining, but they're not lending against a specific property type. Well, if you own that property type, that might be a red flag or what have you. So we're trying to provide intelligence to the market. And we do that in a variety of ways. We pour through about 100 publications every day, and we highlight commercial real estate stories that track that on commercial properties, knowing full well that we can't blanket the entire market ourselves. And we'll summarize them in a paragraph or two and put it out there on our site with links to the relevant publication. And we're also reporting things on our own. We have contacts throughout the industry. We talk to them on a day-to-day basis, find out who's buying what, who's lending against what cap rates are, where the trends are, things like that.
Given that we just went through probably one of the, I guess, the most unique 2 years that most of us will experience in our lives with living through the pandemic, what were some of the most unexpected outcomes as it relates to commercial real estate that you saw over these last 2 years?
The changes in the multifamily sector, specifically the absolute spikes in rents. We're close to, in some markets, rents were up 20% last year, which is just astronomical. And you would expect that when you see rents climb that high, you're going to get a flood of new supply, but that's not happening because of extraneous circumstances. We've got a lack of labor. The supply chain is busted, so construction material can't be had. So we're not seeing the 350 to 400,000 units that we would probably normally see in a situation like this.
Yeah, no, I agree with you on that. And I think one of the other, just giving my own perspective, one of the it was not an expected outcome because it ultimately has not occurred. And maybe you can give some additional insight there, given that TREP, they follow the they have analytics on the CMBS markets and what have you. But the hospitality industry, right? Like of all the industries that probably got its butt kicked a little bit more than the others, the hospitality space did, unless it was a hotel in Florida or some of the other Sunbelt markets, right? Unless it was a resort type hotel in a very few select states and markets. The rest of the hospitality industry just got crushed. And, given that there's a lot of CMBS debt that's tied to the hospitality markets, I was a little shocked to see that there hasn't been more fallout. Not that I would ever wish out upon anybody, any one investor or group, but ultimately that hasn't come about yet. And I've had this conversation on multiple occasions over the past couple of months with some hospitality groups. But do you have a perspective as to is it coming, why it hasn't come as it relates to hospitality?
That's a great sort of subject because we're fascinated by it as well. I mean, you would think hotels went from whatever, call it 70% occupancy down to 30% occupancy in no time flat. Hotels weren't able to pay their debt. So lenders, the CMBS special servicers, or whatever lenders, I mean, insurance companies and whoever's holding hotel debt, they don't want to own hotels that aren't generating cash flow. So they told the borrowers, well, we'll allow you 3 to 6 months or whatever the case might be, of sort of free time. You don't pay interest payments. You don't make interest payments on the loan. Make it up after that, thinking that the pandemic was going to be 6 months in duration. Well, that didn't happen. It lasted 2 years, and in fact, the hotel market still, outside of some markets, still isn't back to where it was in 2019. They provided more debt service deferral, and they've also allowed the deferral of payments into PIP plans, into PIP reserves and FF&E reserves, PIP property improvement plans, and furniture, fixtures, and equipment. So they didn't have to upgrade their hotels in this time. So I think we're coming into an inflection point now where a lot of these the liquidity for the hotel market has improved dramatically. If you've got a hotel, you could get a loan because the lenders believe that hotel performance is going to go back up to 2019 levels in a short time from now. And investors are bidding up some hotels. I mean, we wrote just recently that a hotel in Hawaii sold for an astronomical number, $750,000 a room, which was,
wow.
This property is going to be underwater for a little while because nobody's going to Hawaii yet. and Hawaii relies on trade from Japan, basically, or from the Far East. So the lenders are starting to get a little more they're putting the foot down a little bit, saying we want recourse on some of these deferrals, and that's starting to pinch a lot of hotel operators. So I think the carnage that we were expecting maybe a year ago is probably could happen anytime now.
It's just delayed. Delayed
Yeah, that's right.
reaction.
That's right.
Yeah, I mean, because just speaking to some of the limited service brands that cater to, predominantly cater to business travelers, where, business travel is back to a certain extent, but I mean, a fraction, such a small fraction of that of pre-pandemic levels. It's going to be, and a lot of those hotel operators. I mean, these aren't large institutions that have
Right.
a excess amount of liquidity. A lot of these hotel operators are just individual solopreneurs, or they might own a few a few hotels, but don't have tens of millions of dollars of liquidity to find their way through this mess. And back to what is the future? Back to what levels, right? Does it
Right.
ever come back? It almost reminds me of the crash of 2008. No one knew how deep or how long that was going to last, and ultimately a lot of folks, depending on what asset class you were in and where you're at in your business, a lot of folks had to make a strategic decision to default after a certain period of time, because
Right.
they had ran through their their reserves, and ultimately, again, and now we're 2 years into this. How long does it really last? And I can't hang on forever, right? And so
Right.
it's going to be
Right.
interesting to see how that plays out. And again, I don't wish ill will on anybody, but I guess time will tell. And so, and then another, I guess I'd love to get your perspective on this. I know speaking to, like, some of these major markets, like such as in New York City, obviously
Yep.
the office market. I think the last stat I saw was it's back to about 25% as far as like workers in those
In the office.
offices
That's right.
from the pre-pandemic level. I know the mayor of New York has gotten together with a lot of the larger CEOs that have
Yep.
locations in the city, really pushing them, pressuring them to put together some type of a plan to get workers back in that office, because ultimately the city it's dying because no one's there to spend money. You got a
Right.
little bit of tourism, but you
That's
don't
right.
have that daily work traffic, spending money at the retail stores, the restaurants, things of that nature. And so what do you, again, just general opinion, because you guys get your finger on the pulse of a lot of these stories from all these different areas. I mean, you're talking to just about everybody. And so what's kind of like the underlying consensus of what's ultimately going to play out let's use New York as the example.
Yeah. So you bring up a really interesting subject. So New York is a really diverse market in terms of commercial real estate. So we're seeing there's a new neighborhood, relatively new neighborhood called Hudson Yards on the west side of New York. It's a former industrial area that's now got the most beautiful office buildings in the entire city. Well, companies that had been occupying space in what previously were Class A, the best buildings in New York and Midtown, they're moving into Hudson Yards. So that's leaving all these relatively new buildings, might be 10, 15 years old, in Midtown, in prime locations in Midtown, with substantial vacancies. And the rents in the Hudson Yards area easily over $100 a foot. Just about every big lease gets done at more than $100 a foot, which is that's a number that it's a big benchmark. It's kind of unheard of in prior years. What we're really curious to see, and office leases, at least in the cities, tend to be 10 to 15 years in duration. So we won't know, as you said, like 25% of the people are actually filling up the actual space in buildings at any given time. When a company's lease comes up for renewal, will they cut back the amount of space they need because they'll be going to sort of more of a hotel type office operation where people share cubes or desks and things like that. So and what happens in the office market sort of reflects on will influence how well the retail market works in New York. And some New York retail space is very big ticket. I mean, it carries high rents and it's very valuable. Outside of New York, Chicago's Miracle Mile has a 26% vacancy rate, which is unheard of. And that's another. I mean, these are very high-end tenants in a normally highly trafficked retail area, but nobody's going there.
Have you seen an upshift in like readaptive uses of, again, not necessarily speaking just to New York, but of any maybe office buildings that were already struggling a little bit that
Yeah.
ultimately, got really, smashed down by the pandemic, and now there's an alternative purpose focus on that building?
Yeah, sure. In fact, we're working on a story for today. There's a building in Houston that recently sold for, I'm going to say, 20%
I
of
saw that.
the balance of its loan. 20-story office building, almost 500,000 square feet. BP Conoco had the occupied space in it. It's going to be converted into apartments.
Hmm.
This is, 3 years ago, this was a CBD office building. Who'd have thought that they'd convert it into apartments? But there we are.
Yeah, no, I did read that article. I think that came out a week or two ago. No, that's very interesting. High end luxury apartments. I forget what the price point was on them, but they're very, very high end, if I recall.
Yeah.
Um,
Yeah, one of the things that we're very focused on right now is given the rents, multifamily rents have been climbing, call it 18 to 20%, and it doesn't seem like that's stopping. They're continuing to climb simply because of supply and demand. In most markets, I mean, major markets aren't seeing those types of increases. San Francisco rents are still low, but the affordability is going to impact the user base, the tenant base, basically. Um, we're very curious to see how that kind of all shakes out. I mean, will there be resistance? Much like we saw resistance in the used car market. Finally, used car prices are kind of start stabilizing and declining because people are saying, "I'm not going to pay for that much."
yeah.
Are we going to see that in the multifamily sector?
Have you heard any hints from municipalities or I guess from a regulatory standpoint, in a more what would historically been a more landlord friendly market? Have you heard hints of rent control? Has any of that been spoken just behind the scenes, or are there any whiff of that at all?
Yeah. So, you see that in the kind of the most in certain areas. You don't see that like globally in the United States. I mean,
Sure,
but you see that in New York. You see that in kind of in
that's
the
a
very
given,
high end
right?
areas in California and stuff like that. But it's not. We haven't seen that like throughout the country really.
Okay. Got it. Like I
Yeah,
know a number of the markets here in Florida. Yeah, I'm based in the Tampa Bay area. I think in 2021 rents, I think in somewhere 27 to 30%,
yeah,
up from 2020. I mean, again, at some point that's not sustainable. And
right,
even in a Florida being considered and classified as a very landlord friendly state,
right,
is there a threshold to where regulators step in and ultimately say, you know what, like one of the major industries in Florida is tourism. And at some point,
right.
our service workers literally aren't, they can barely afford it now. And so we've got to do something to protect them. And I know that there's all those states that in markets where, again, speaking to California and New York and many others that you just like, that's typically the norm there. But in some of these more landlord friendly Sunbelt states, I'm just wondering if you guys had heard any whiffs of any regulatory changes coming about because of the just Texas, same thing. Dallas,
Right.
Houston. I mean, rents are up 20+% year after year the last 2 years, and how long can that be sustained? So
Yeah,
time will
yeah,
tell, I guess. Time will
yeah,
tell.
yeah. That's right. I really hope that regulators and municipal sort of officials and stuff understand that you can't play with the market like that.
No, you can't. It doesn't ever works out
So
at all.
because what happens in every market where you have rent control, you have a dearth of available units, so it doesn't benefit anybody.
Yeah. So I want to switch back gears to, we briefly just, glossed over it in the beginning, speaking about commercial real estate direct, your initial involvement, and then ultimately there were some struggles with the company. You stepped in, put on your entrepreneurial hat, and said, I'm gonna take the helm and lead this ship." And then ultimately, after a number of years, and you can fill in the blanks there, a number of years, you're still with the company, but ultimately you sold it to Trep LLC. And so maybe I'd love to hear about kind of that initial step into the entrepreneurial world, any challenges that you had, and just any roadblocks that you faced as you took over the helm of that company.
Sure. So it's funny. It was I forget what the cliche is, but uh, you do things because that's what you do, right? I mean, had I not acquired commercial real estate direct, I would have said, well, what am I going to do now? I got to find a job, So it was by necessity almost. And I was very fortunate. I mean, there were some struggles during a global financial crisis. We were heavily, I don't want to say embedded, but a lot of our biggest customers were Wall Street banks because
Mhm.
because of our coverage of the CMBS market, and that hurt us tremendously, forcing us to make a lot of sort of cost control changes, reducing headcount and things like that.
When did
Uh,
all that occur? Just give some additional context there. When did that acquisition occur? When did you step in?
in 2001.
Okay, got it, got it.
Mhm.
So right
So that
after
was
the dot-com
at the
bubble,
tail
then
end
is
of
what.
the dot-com bust.
Got it, got it.
Mhm.
And what was the unraveling? I mean, what ultimately occurred that the business started unraveling to where you kind of stepped in as the hero?
Well, so we were venture capital funded.
Hmm.
The goal was to develop a bunch of different operations like commercial real estate direct. Launch one covering the energy business because we did that, and one on the Far East business, sort of trade, Far East trade, and another on venture capital. Um, as venture capital dried up, we couldn't continue expanding.
Got it.
And during the dot-com years, expansion was the goal. Didn't matter whether you were profitable or not; it was just expansion. But it just so happened that we had a number of subscribers. We were already cash flow positive, us as an individual unit. So I was very confident that we could just continue doing what we were doing and generate additional clients. And our clients are very, very sticky. They've been loyal with us. I mean,
Hmm.
once you're a subscriber, you stay a subscriber, generally
Yeah.
speaking. And that was true when we were like swimming on top of water until 2008 hit, and then we were drinking water at that time.
Were there any major shifts in the business model that you instituted once you took the helm?
So we wanted to increase the amount of data, sort of proprietary data that we could offer our customers, and we've done that. We've got so because we've been publishing for over 20, well, now 22 years, we've compiled a great deal of property level data, property sales and property financing data. So we make that available to all our customers through a searchable database. So if you want to find out, what building this, how often this building had traded over the past 22 years, you could search on our site for that.
Yeah,
So our
fantastic.
archive has become one of our most valuable sort of assets.
Got it. Got it. What were some of the biggest? Give me some of the biggest lessons that you learned during your time there. As as again, you're still you're still at Commercial Real Estate Direct, but ultimately had sold it to TREP LLC, years back. And so, but give me some of the biggest lessons learned. I mean, I'm sure every day was a new one, but just maybe pick the top two or three during that time at the helm.
Yeah, hire the best people you can,
There you
and
go. Pay
that's the
for it, right?
hardest thing
Yeah,
you can do because
that's it.
when you hire someone, it's always a crapshoot. So it's that's the biggest challenge of running your own business is
Yeah.
hiring the right people. But once you've got the right person, the trick is to keep them.
Hmm.
So you're constantly want to sort of challenge them and make them shine.
Yeah, no, that's great advice. Yeah, actually, you get what you pay for.
Yeah,
Is
yeah,
what it
that's right,
is.
that's right, that's right. And sometimes you don't realize who's going to shine and who's not. So
Yeah, I agree with that. That's a very good point. It's not necessarily what you pay for, because there's been plenty of times where we paid top dollar and it just hasn't worked out as planned. So, in any event, so I love to, again, your guys, you got your fingers on the pulse of just about everything that's happening in the commercial real estate world. And so, what, speaking back over the last decade, right? So let's cover the entire decade. A lot has happened over the last 10 years. What are some of the the biggest and most noticeable trends that you've seen over this last decade or so?
all right, so over from 2012 to till now, the death of the shopping mall.
There we
It's
go. Okay.
it's been most evident between last 10
Hmm.
years. So in 2012, lenders were still quite actively lending against shopping malls. I mean, you had four viable anchors in existence: Macy's, JCPenney, Sears, and Dillard's, and a couple others. But those were the four major ones. We're seeing and this is not an exaggeration, the shopping mall is dying basically. I mean, exclusive of some of the best malls that are owned and managed by Simon Property Group, Taubman, and a number of others. But we'll probably see a reduction by 25% of shopping malls. And the interesting thing is, so industrial might take chunks of old shopping malls, and which historically that would have happened because industrial space rents for whatever it is, $6 to $10 a foot, whereas retail space rents for a multiple of that. The rents at industrial space, especially last mile locations, is increasing dramatically. So now a shopping mall is more financially viable, which is kind of, who would have thought this 10 years ago? We'd have never thought that.
Are there any notable projects of recent that you've seen that type of conversion take place?
There are, and
I put you on the spot by asking
you that. Now I can't remember the names.
Yeah.
But so we're in the Philadelphia suburbs, and there's a shopping mall here called the Montgomeryville Mall. It used to be a Simon property. Simon gave up on it. They had borrowed $100 million against it. I'm going to say 2012. It might have been 2014. They lost an anchor. They replaced it with a Wegmans, which is an area grocery store, very well known and very sort of popular grocery store. But as you know, people who go grocery shopping don't go into malls. They're not buying stuff at the whatever they call it, the store, the hat store in the mall. That property is as most malls are, it's in a hub. A big chunk of it is probably, and it sits on 100 acres of land. A big chunk of it's probably going to become apartments. It's a perfect place for apartments.
Yeah.
And it's definitely going to be redeveloped, but we don't know when.
Yeah, no, that's interesting. Yeah, death of the mall. Right? Who would have thunk? But I guess your retail has been going through some major shifts over the past decade alone, and then ultimately, the shopping habits of individuals, especially with the kind of the the power center type of places where outdoor venues where you don't have to walk through an enclosed area to get to each individual store, and people want their things now, right? And so delayed gratification, I'm not sure that can even be a terminology anymore. It doesn't really exist.
but and that said, not all malls are going to die. I mean, we were in Orlando not too long ago, and Simon has an outlet mall in Orlando, and it's thriving. People. I mean, it's like in the Tokyo subway. It's just jammed.
Yeah, we've got a mall here in Tampa called the International Mall, and it's run by Simon Property Group, and it's incredibly high-end stores. And I try to stay away from malls as much as possible, but I happened to find myself there sometime over the I think post-holiday season, and it was absolutely slammed. I mean, it was a Monday or Tuesday afternoon, and that place was cranking. So they're not all dead. They're not all dead. So how about crowdfunding? Again, that has been an interesting ride over the. I don't know when the. Forget the year that the Jobs Act was passed.
Right.
2012.
Yeah, I believe so. Either 11 or 12.
Yes. Mm-hmm. And so since that point in time, crowdfunding is it's the new way.
For sure. And we've seen over the past year, it's probably even less than over the past year. It's been adopted by institutions. But by institutions, I mean, these are developers who previously only relied on institutional capital. They'd go to Heinz or whoever for capital. And now they're saying, we'll go to Heinz for a big chunk of our capital, but we're going to carve out 15% for the crowd. It diversifies their equity base. Mm-hmm. And it it allows them to reach a whole new level of investors. We're compiling data on the non-traded REIT sector with the help of Blue Vault. I mean, we use some of their data and we add to it. And this isn't quite crowdfunding, but it's non-traded REITs. There's another sector that has changed dramatically over the past decade or so. Blackstone dominates that area, and they're raising capital. I mean, the reason why they did that is they wanted to raise capital from retail investors. Yeah. So the institutional capital market they believe, Blackstone and other investment managers believe that they've been saturated already. So every year they're going to increase their allocation to real estate by 0.5% or whatever, and they'll get their chunk of that. So that's a marginal growth for them. But you have the retail investor base, which is in the trillions of dollars of investable assets. 10% of that should be in real estate, or at least that's their argument. Why not pursue that? So they're doing that directly through their non-traded REIT, and these developers are doing that through the crowdfunding platforms. And the crowdfunding platforms, when the Jobs Act was passed, there were dozens. We've seen some consolidation, and there's still a fair number. There's maybe a half a dozen or so that are really, really active. CrowdStreet, Realty Mogul, Arbor Crowd. And I'm going to miss a couple, and they're going to call me up and say, you forgot us.
Well, no, I think it's a beautiful thing, giving that retail investor, access to an area or an investment type that was not really possible before. I mean, unless you knew somebody who knew somebody who knew somebody, you typically weren't, you didn't have access to the types of investments that are available now. So I think it's a beautiful thing, and I think that obviously the trend is going to continue to grow. And lastly, one of the other big noticeable trends that I've seen, and I'd love to get your perspective on it, is the build to rent space. Let's talk about that. That is an absolutely booming space. And so, what are you seeing? What do those shifts look like, and what do you see as the future of build to rent?
So institutional adoption. That was a business controlled by moms and pops. Small investors that had 2 or 3 houses that they would rent or whatever. So it's highly, highly fragmented, and still very fragmented. Now institutional capital's coming in. I initially thought, and when this became a trend, whatever it is, 4 or 5 years ago, I thought it was just a trade. They're going to buy the houses because the market was in the toilet. This goes back to 2012, I believe, when they started doing that. So it's more than 5 years ago. And then they would sell out, and it would go back to being the fragmented business that it was. But that's not the case. I mean, one of the biggest owners of not necessarily build to rent, but single family rentals is Starwood Capital Group. So it's, and we're seeing developers. So a build to rent is basically an apartment property that's horizontal, right?
That's it.
And they're looking at it that way. I mean, they have an economy of scale because they have 100 lots that they could mow at one time. Even though in an apartment building you don't really mow a lawn, but that's what it's become. They're looking at it that way, I think. And people who who are maybe priced out or don't want to buy are saying, yeah, I want a house, or I want something where I have my own backyard and a little more space as opposed to an apartment. So it's here to stay. It's not a trade.
I agree with you. Orest, this has been a lot of fun having you. I really appreciate you coming on the show. It's just been lots of great information shared, and you guys keep up the good work over there, because you do phenomenal work.
Well, I appreciate it, Kevin. Thank you very much for this opportunity. Thanks.
Alrighty, guys and gals, just one quick mention here before we wrap it up for the day. And I haven't mentioned this for quite some time, but for those that don't know, I'm actually based here in Clearwater, Florida, which is in the Tampa Bay area, in case you didn't know. And I mention this because I've personally had the opportunity to connect in person with many of you listeners over the years, over the 8+ years that I've been doing this show. Sometimes we grab a bite to eat together. Sometimes we grab a beer. Just really depends on what's on the schedule, right? But so if you find yourself in the Tampa Bay area for one reason or another, and you'd like to connect with me, go ahead and go to my website, kevinbupp.com, and go to the contact page and just provide some details of your visit. And ultimately we'll see if our schedules can line up. So again, just go to my website, kevinbupp.com, go to the contact page and put some details on there about when you're coming to town. And I love meeting others that are either in the space, love this talking shop, or just, getting to meet others that are looking to get into the commercial real estate investment space, and just, shooting shop. That's more than anything else. So again, if you're in the Tampa Bay area, look me up. We'd love to connect. And aside from that, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. So you take care.